Hello, and a very warm welcome to the SBTi Finance Update and Showcase of Leading Science-Based Targets webinar. We're going to get started since we do have a pretty packed agenda. And so I'm just going to kick it off right away. My name is Paulina Tarrant, and I'm the Net Zero Engagement Manager at the Science-Based Targets Initiative. We are broadcasting live today as a Zoom webinar, and the recording and the slides will be available to you on YouTube and on the SBTi website after the event. And the session today will be about 60 minutes. Please be reminded that if you have any questions throughout the presentation, please type them into the Q&A box in the function in Zoom, and that can be accessed at the bottom of your screen, and we have members of the finance team ready to answer some of those questions for you. So next slide, please. So I'm pleased to be joined today by the SBTi's Sector Finance Lead, Nate Aiden. He will be leading you through the presentation today. And then we're also joined today behind the scenes by our expert SBTi colleagues, and they will also be answering as many questions as they can in writing as possible. So they'll be looking at the Q&As through that function. And if we don't get the opportunity to cover all of those questions today, we will respond to as many as possible on our website and social media channels after the event. And today we're also joined by a group of leading financial institutions with validated science-based targets. And so I'd like to give a very warm welcome to Supriya Sopti from the leading bank NatWest Group. Then we have Jenny Mill from asset management company Schroders, Marcus Bruns from asset owner Storebrand, and finally Gustav Magnuson from private equity firm EQT. Thank you all for joining us today to share details about your science-based targets. So just in a moment, I'm going to hand it over to our finance team lead, Nate, to provide an update on the SBTi's finance progress to date and future work. And then we'll follow with 4 presentations by the financial institutions that are here with us today, and they will each answer the following 3 questions. So what is included in your science-based target? Why did you choose to set a science-based target? And how does the science-based target relate to the net zero journey? And with that, I'll wrap it up and hand it on over to Nate Aiden, our sector lead for finance. Thank you.
Wonderful. Thank you, Paulina. And thanks everyone for joining today. So really the financial institutions are the core of today's webinar. But just to give a little bit of context, I'll give a brief update and talk about some of our recent work and priorities for this year going forward before passing it over to the headliners here today. So in terms of some context, as I think most folks on this webinar know, the SBT initiative was launched back in 2015. And that year we launched a call to action for companies and financial institutions to set targets, and 12 did that year, and 10 of them were financial institutions. So there's been a lot of interest from financial institutions from the very beginning. However, we didn't have established methods and data for scope 3 target setting for financial institutions. And so we began that project in 2018, and in 2020 launched the finance sector guidance, which included 3 methods for near-term target setting. Those are the SDA for sector targets, physical intensity targets, and then 2 engagement methods. One is SBT portfolio coverage, and one is temperature rating. And so you'll hear about those methods today and how the financial institutions have actually used them within their own portfolios and activities. For some additional context, this slide just shows key publications and events over the past 8 years. And you can see that the conference of parties have been key events, as well as the IPCC reports. So last year we had the AR6, the 6th assessment report, mitigation report, which found that financial institutions need to invest 3 to 6 times more in mitigation for us to be able to stabilize our climate at well below 2 degrees. Another big report last year was the UN high-level expert group on net zero, which published a report on net zero target setting best practices. And that's really influencing some of the SBTi work going forward. There are 3 recent publications from SBTi that I'll just highlight here. One is our Net Zero Foundations paper that we published last April and that we're presently working to update with a new net zero standard. The second is some finance training modules that we posted to our website and also have on YouTube that are intended for a comprehensive look at science-based targets from the first understanding of how the process works to how they get implemented and achieved. And then finally, we recently published a new guidance document on linking Science-Based Targets Initiative for financial institutions with TCFD, that's the Task Force for Climate-Related Financial Disclosures. And so sort of closing that loop between the impact of climate on financial institutions and the impact of financial institutions on climate. So that's a bit of background. In terms of this year, we will be focusing on that net zero standard that I mentioned and aiming to get that exposure draft of the net zero standard out in the next couple months. Beyond, well, that will include some new thinking about portfolio alignment, as well as the coverage that's required for financial institution targets, and some thinking about fossil fuel investment policies and how that needs to be specified in these net zero targets. Beyond the net zero standard, we'll also be focusing on harmonization with peer initiatives such as the net zero initiatives and PRI and IIGCC and some of our other financial institution initiatives that are working in the same space. We're also broadening our asset class method coverage, starting with insurance underwriting, but also looking at other asset classes to develop new methods. And then finally, we expect to be updating the near-term criteria to incorporate this net zero standard as it becomes fully developed. Within our work, scaling up the near-term targets is a priority. And so we've been very happy to see the accelerating growth of the near-term SBTs, where we finally surpassed 50 recently. And you can see the distribution here in the pie chart on the right. What we've noticed over the past year is that we've really had a shift from in 2021, we had mostly private equity firms. So today we're represented by EQT, one of our first financial institutions with an SBT. But then in the past several months, really banks have been the largest category of financial institutions setting SBTs. And so we're very happy to have NatWest representing the banks here today. But you can see there's quite a diversity. So the next largest category is asset managers. So very happy to have Schroders here as an asset manager with an SBT. And then finally, one of our new growth areas is asset owners. And so one of our asset owners with an SBT is Storebrand, which is also presenting here today. So we are very pleased to be able to have all of these leading financial institutions speak to you directly about their SBTs. And without further ado, I will pass it to Supriya to talk about the NatWest target.
Thanks, Nate, and hello, everyone. I'll start with why we set science-based target and a little bit of an overview of our climate ambition and strategy. So if we move on to the next slide, our journey effectively started from 2020 when we set our climate ambition to be a leading bank in the UK to help address the climate challenge. And we said we wanted to halve the climate impact of our financing activity, which is our loans and investment, by 2030. We also set ambitions for our own operational footprint. And that has gradually evolved, and we have now said we want to be net zero by 2050. So as part of these ambitions to reduce our emissions, we were quite keen to set sector-specific targets to monitor our progress and also to make sure we are on track to meet our wider ambitions. And our work, we wanted to make sure that we were following standards, external standards, etc. So we were the first bank in the UK to sign up to the Partnership for Carbon Accounting Financials. and now the first major bank in the UK as well to have science-based targets. So I guess our intention and our reason for joining SBTi and having validated science-based targets is because it's part of our journey to net zero, and it helps us assess where we are against our climate ambition. So if we move on to the next slide, please. We've sort of since 2020, and we started our measurement process in earnest then. Obviously, we were looking for standards to develop as well as setting ourselves internally. So in terms of how we went about the journey, we gathered sort of SMEs from various areas to make sure we had a well-rounded approach to calculating our emissions as well as assessing our targets, what would be our targets. Obviously, there have been challenges along the way. Most of our emissions are coming from our lending to customers. And there is a lack of availability of granular customer data, as some of you who are going through this journey will know. Obviously, the standards are developing, etc. However, it has been an eventful journey, but last year we published emissions intensities, as well as our science-based targets that were later validated for about 50% of our book. So on the next slide, you'll see kind of the details of what we have published in our climate report last year. And we are continuing to develop the journey and extend the scope of the calculations of emissions. In terms of specifically about what is in our science-based targets, so our science-based targets effectively cover our own operational footprints. If we look at the next slide, please. It covers our own operational footprint as well as our financing activity, which is the loans and investments on our balance sheet. For our financing activity, we have covered 79% of our lending and investment book. And we have used two approaches, the sectoral decarbonization approach, as well as the temperature rating approach. Where possible, we have used the SDA, or the sectoral decarbonization approach. So residential mortgages, commercial real estate, these are big parts of our balance sheet. And for the rest, where methodologies are still developing, we've used temperature rating with an intent that we will gradually move to SDA as methodologies develop and better data, etc., is available. For our own operational footprint, we have said we want to halve by 2030, both all scope 1, 2, as well as scope 3. So that's the work we are doing now in terms of setting our transition plans, or formalizing and reiterating our transition plans to make sure we are on track. So these targets, obviously we set these targets in terms of how they become part of our net zero journey. So as I mentioned, most of our emissions are coming from our lending to our customers. So a big part of the actions we are taking, a big set of actions in our transition plans relate to supporting our customers' transition. So on the next slide, you'll see some examples of what we are doing. So we have various tools to support our customers. So we have the Carbon Planner, which is for small and medium customers as well as small companies, so that they can assess their carbon footprint by inputting their data into this tool. It's a free-to-use tool. And the main reason for this is that we believe the more we educate our customers, the more we educate people, the more likely they are to take climate action. Similarly, in the middle, you see our retail app. So when people log into their bank accounts on an app on their phone, they can see their carbon footprint if they have signed up to do that. And as I said, mortgages is a big part of our balance sheet. So to steer that part, we also have a green mortgages as a product to support purchase of energy efficient homes at a more discounted rate than normal mortgages. So as I said, these are a couple of examples. We are also working alongside the industry. We have various partnerships to support, say, for example, the electric vehicle charging network, or for homes, we have a Green Homes Coalition with other corporates in the UK as well. So the reason and how SBTs support us is, as we are taking these actions, we are then making sure that what we are actually doing and achieving in terms of reducing carbon emissions on our balance sheet is happening against the science-based targets we have set. I'll just finish off with the last slide. I think one of the key principles we are following, and this is where it comes in terms of regular monitoring, right? So we are trying to embed climate within our decision making. It's great to do measurement, it's great to set targets, but unless we actually think and evolve the targets and embed them into our decision making, we won't make a lot of progress. So I think that's exactly what we are doing for the last few years. So we are making sure, emissions, carbon numbers, science-based targets, etc., are available for people to see. They are part of our regular management information. As I mentioned, we continuously reevaluate our transition plans and continue to set them, as well as including climate within our risk considerations and regular monitoring of the science-based targets as well. So that in a nutshell is sort of our journey in terms of our measurement, developing a measurement capability to setting our science-based targets and the next steps. Nate, I'll hand back to you.
Wonderful. Thank you, Supriya. And yeah, just for some context, the NatWest target is one that we're very pleased with insofar as it's a robust target and it goes well beyond many of the SBTi minimum criteria and thresholds. So it's quite ambitious and really a great precedent for other banks to see what climate leadership looks like when it comes to setting targets. Now I'm happy to pass this on to Jenny Mill with Schroders to talk about their target from an asset management perspective. Over to you, Jenny.
Thanks, Nate. Yep, thank you for having me today. I'm Jenny Mill and my role is a climate change strategist at Schroders. So we're a global asset manager investing across a range of asset classes with around $700 billion of AUM. Schroders set a science-based target with a 2019 baseline covering our direct emissions under scopes 1 and 2 and our scope 3 emissions, which of course includes our investments. And this was in line with the commitment that we'd made through the Net Zero Asset Managers Initiative. And as a financial institution, our biggest climate impact is definitely from our investments. Our financed emissions are around 6,000 times bigger than our direct emissions. So to put that in perspective, our baseline group financed emissions are about the same as those of Singapore, whilst our operating emissions are about the same as a small town. So I'm going to focus today on our financed emissions target, which are on the slide on the right there. So we have committed to align our financed scope 1 and 2 emissions to 2.2 degrees Celsius by 2030, and our financed scope 1, 2, and 3 emissions to a 1.5 degree pathway by 2040. This target covers around 62% of our assets under management currently, and we plan to increase coverage this year. Our target was validated last year by the SBTi in February 2022. So on this slide, I'll cover why we set a target, why we chose the SBTi, and then the methodology within the SBTi's framework that we chose. So setting a science-based target really reflected our commitment to climate action, and making the decision to set a target was relatively straightforward because we were very focused on climate change already. We'd been running a number of different climate risk analyses and looking at investment opportunities from the low carbon transition. The difference today compared to a few years ago, though, is that the transition's gone from being a possible risk to being a probable one. Therefore, setting a target to decarbonise aligns with our approach to managing risk and seeking investment opportunities. It made sense for us to set our target using the SBTi methodology. It reflects leading industry standard, represents a strong coalition of highly recognised organisations like CDP, WRI and WWF, and it uses industry standards like the PCAF and Greenhouse Gas Protocol. Having our target assessed by an independent third party gave us confidence and credibility in our approach. And the methodology also allows us to consider what we felt would be the most sensible option for setting our target, given our size, the types of asset classes we hold, and the decarbonisation strategy that we want to pursue. We ultimately chose to adopt the temperature alignment approach, which provides a consistent and intuitive scale over time. It focuses our attention on the emissions and the targets of the companies we invest in. So our group level temperature score is impacted by whether the companies that we invest in have set targets, first of all, and then it's weighted by the companies to which we have the highest exposure and which have the highest emissions. This gives us a really detailed view of the progress of our portfolios from individual issuer level to fund and investment desk levels, and then all the way up to the group level through the aggregation of temperature scores. One of the most important elements of the temperature alignment methodology for us is the fact that we're looking not just at net zero targets that are 30 years from now, but across different timeframes. We know that the next decade is critical for climate action, which is why we have set interim and long-term targets. This makes it vital that we understand which companies have set interim and long-term targets themselves, and encourage those who haven't yet to do so. Furthermore, the temperature alignment score gives us the breakdown of targets set across different scopes. And this is really important as we need companies to set targets across their value chain. Our approach to reaching our target was set out in our Climate Transition Action Plan. I won't read everything on this slide, but it summarises how the targets come together in our group strategy with both our investments and our operations. We've been on this journey for several years, but the setting of our science-based target really formalised the process such that we now have clear ways to monitor our progress, report regularly to our senior leadership, including our Group Chief Executive, and report publicly through our annual TCFD reporting. Our net zero approach is really grounded in our views on climate change rather than on our science-based target per se. It's important that financial institutions obviously set targets, but net zero gives us that common goal, but not necessarily the steps to get there. And this makes a huge difference to return implications. As an asset manager, there are broadly 4 levers at our disposal to reduce emissions. We can sell high carbon assets, but this has little impact on real world emissions reductions. We can increase our investments in climate solutions, which is something that we're definitely increasingly doing across our product line. However, as a global asset manager, we can't build diversified portfolios from those companies already committed to the transition. There are offsets, and we think there will be some role to play for offsets in reaching net zero, but these should really be seen as a last resort, and of course, further work is needed to ensure their quality and credibility. So then engaging with our portfolio companies to establish ambitious decarbonisation targets and strategies is really key for us to make meaningful contributions to decarbonisation across all sectors and asset classes. The scale of that engagement demands it be approached as a whole firm effort, and we've established engagement targets for all our analysts and fund managers on which they're assessed at the end of the year. So given our focus on engagement, I've just set out here on the slide our climate engagement strategy to transition our investment portfolios. The first element here involves setting clear expectations with the companies we invest. We expect large and medium-sized companies to commit to decarbonising business models towards net zero by mid-century, to set long, medium and short-term science-based targets covering scopes 1, 2 and relevant scope 3 emissions. We expect them to publish a detailed transition plan and then publish their performance and progress annually. Secondly, we've prioritised our engagements on the companies that we've the highest exposure to and which are the least prepared for the climate transition. Across our investment desks and active ownership team, we engaged over 700 companies in 2022. This represented the biggest engagement programme we've ever undertaken. We engaged them on our climate expectations, and that offered a really useful roadmap for improvements. Thirdly, we also developed analytical tools available to all our investors, providing our financed emissions and temperature alignment numbers over time. This allows us to track our progress against those targets, drill down into results at various levels, such as regional sector views, and also at company, fund and desk levels, and then all the way up to our group score, as I mentioned earlier. This has also been really helpful to helping us to identify the companies that we should prioritise for our engagements. And when we combine our engagement data and our analytical tools, we find that companies that are part of our engagement programme were more likely to adopt a climate target in 2022. And we're continually looking at data such as this to understand the impacts of our engagement on target setting and on decarbonisation, which are critical to our strategy. And lastly, our analytics are also increasingly informing our positions on voting, including shareholder resolutions, say on climate resolutions, and voting against boards. Tracking progress with the companies we've engaged with acts as a flag to tell us if a company has not taken the action that we need, and then that triggers our escalation process. So I'll just finish with a bit of a focus on what we're doing this year. So as already mentioned, our big focus is on engagements, and that continues from last year into this year. We'll be continuing to identify the companies that are high priority using our analytical tools. And this means in some cases that we're going to be continuing the engagements that we'd started last year. And in other cases, there'll be new conversations. Using our net zero tools, we have found that there have been improvements in the number of issuers setting targets. So in 2022, almost 30% of issuers had set targets, up from just 9% in 2019. Similarly, we've seen improvements in the PCAF quality scores for financed emissions, enabling us to use more reported emissions data rather than estimates. However, there do remain some gaps, for example, in emerging markets and with smaller cap companies, but we're able to use all these insights that we're collecting to inform our engagements. Secondly, we're going to be focusing on expanding that coverage of our target into additional asset classes. So we've obviously got that aim of having 100% of our AUM covered by our target. So this year we're going to be focusing on our externally managed funds, sovereign bonds, real estate, private assets, and some project finance as well. Finally, this year we're looking at working more closely with our clients, not just to provide them with the net zero insight numbers we have for their investments, but also to support them as they approach their own net zero targets and decarbonisation journeys. And we know that the transition is not going to be possible unless every company and financial institution takes action. It's therefore important for organisations to share their experiences and learn how we can do things better. So I'll just end by saying thank you for the opportunity to hear from other financial institutions today and to let us share our experience of the net zero journey so far. And with that, Nate, I think I'll hand back to you.
Thank you so much, Jenny. Before I hand it on to Marcus, I just want to quickly remind everyone to please use the Q&A function in Zoom to ask any questions of the SBTi or of the panelists. If there's time permitting at the end, we'll have some Q&A. And with that, I'd like to hand it on to Marcus Bruns at Storebrand. He's the SVP of the and Nordic Head of Sustainability.
Thank you very much, and great to be here with all of you today. So my name is Marcus Bruns, and I'm working for Storebrand. So Storebrand is the largest asset owner, asset manager in Norway, with more than 1,000 billion Norwegian kroner in asset under management, with more than 2 million customers, mainly located in Norway and Sweden. And sustainable investments is a topic we've been working on for a very long time, actually dating back to 1995. This is a very important topic for us. Within sustainability sphere, climate change and climate strategy is an important topic. And back in 2019, we laid out our climate strategy and covering the whole value chain. This both covers our own operations, where we set a target of reducing our emissions with 7.6% per year, aligned with emissions gap report, and also implemented an internal carbon price of $100 for air travel. On the procurement side, we have clear targets for our suppliers when it comes to both reporting emissions, setting targets, and also compensating for residual emissions. And on the investment side, we have a clear target of net zero emissions by 2050, aligned with the 1.5 degree scenario. As a part of this climate strategy process, we are one of the founding members of the UN-convened Net Zero Asset Owner Alliance, which in addition to having the net zero target aligned with the 1.5 degree scenario, also has a focus on emission reductions in the real economy. In addition, also setting up intermediate targets every 5 years aligned with the Paris Agreement. We've been a part of establishing this target setting protocol and communicated our targets aligned with this document. The goal is to reduce our the emissions scope 1 and scope 2 from our total equities, corporate bonds, and direct real estate investments by 2025 with a 2018 baseline. We also have a target of investing at least 15% of our AUM in what we define as solutions. So that's either solution companies, green bonds, certified green real estate, or investments in sustainable infrastructure. And also we have an active focus on active ownership. Of course, it's a broad topic, but having a special emphasis on the 20 largest emitters in our portfolio based on owned emissions or financed emissions, which then stand for these companies stand for a large part of our financed emissions as a group. And then lastly, we're also focusing on the customer engagement to making it easy for our clients to both understand and also contribute to a low carbon future. And as you can see, both the first and the third target here are closely linked to the targets I'll be showing from the Science Based Targets initiative. In 2019, one joining the Net Zero Asset Owner Alliance and also working on our climate strategy, we also signed up for the Science Based Targets initiative and committed to setting targets aligned with that framework that would be coming up later. And since then, we've been playing a part in developing this framework, been a part of the expert advisory group, and also had a case study for Storebrand Real Estate in the first publication, and been a part of the working group for the temperature alignment tool. And then since the publication of this target setting protocol was official, we've been working on setting our own target and got that validated now in December 2022 and communicated now in the start of this year. Our targets on the portfolio target side cover 81% of our total investment and lending activities by invested assets as of 2021, and the targets are divided into three main categories. Firstly, it's on our own operations, where we said that we're going to reduce our absolute scope 1 and 2 emissions by 52% by 2030 from a 2018 baseline, and also continue sourcing 100% renewable electricity through 2030. So in this sense, we're using a location-based method for our scope 1 and 2 emissions, but also including a market-based target for the procurement of renewable electricity. For our equities and corporate bonds, we've said that we commit to 42% of these investments to have set science-based targets and have them validated by 2027. And for direct real estate, so we have a target of reducing the emissions by 64% per square meter for residential buildings and 71% per square meter for commercial buildings by 2030 from a 2019 baseline. On the portfolio coverage target, we will then be, the method will reflect the latest SBTi guidance and methods available to enable companies to set targets and also achieve the SBTi approval. And it's really important that if we're going to be able to reach this target, that we expect that the Science Based Target Initiative continues to do method development and also expanding the sector guidance and has sufficient validation capacity, because that's is the important topic to be able to kind of see the majority of companies moving along. From our side, there's two main actions that we do. One is on the influence that we can have through our ownership dialogues and also through our voting, especially when having active ownership and dialogues with the largest emitters in our portfolio. There's been a focus on setting science-based targets and also pushing for SBTi validated targets. We also have work on what we invest in. So SBTi is, for example, a part of some of our fund strategy, like the Storebrand ESG Plus strategy, where the fund optimizes, among several other things, on companies that have validated science-based targets. And it's also included when we as an asset owner set up our investment strategy with clear targets mandated in that investment strategy. For our direct real estate investments, we've then used the sectoral decarbonization approach. And for now, at least, we've used the market-based method, but we're going to be reporting on both location and market-based scope 2 emissions and track them across the real estate portfolio. One of the reasons that we've done this is due to some of the issues we saw on the location-based method when it, for example, comes to producing solar on or kind of more solar power on one building and then transferring that over to other buildings. But if the methods change, we're also considering updating this target to a location-based target. The three approaches that we've set that are also then in prioritized order is starting off working to make our buildings more energy efficient, to reduce the energy consumptions in the buildings. Secondly, to increase the on-site renewable energy production, mainly focusing on solar. And then lastly, to purchase offset renewables through guarantees of origin or other instruments like the power purchase agreements. So as you can see, the two first initiatives are also very closely linked to what would be needed in a location-based method. There are, of course, many reasons to set science-based targets, and 3 points that I want to bring up here today is that firstly, it's an external validation of the targets. So it's not just Storebrand saying that these are our climate targets and they're aligned with science, but it's also having a third party validating this targets, which also gives credibility to the work. Secondly, it's consistent with our requirements that we put on companies that we suggestions that we put on companies that we invest in. So coming into the dialogue with them and saying that this is a target that we've committed to, and also wanting them to to commit to a similar target gives also more credibility. And lastly, this also has a commercial aspect. We already have customers asking us when we are planning to set science-based targets, because they have their own supply chain targets and where we fit in as an important supplier to them. And lastly, it's important to note that these science-based targets are very well aligned with our net zero journey and the climate targets that we have as a group. Thank you for participating here, and feel free to reach out either in the chat or on LinkedIn or email if you have any follow-up questions.
Thank you so much, Marcus, for presenting. With that, I will move on to our next presenter. Thanks. And so we have Gustav Magnusson from EQT.
Thanks, Paulina. Great to be here, and thanks for having me. As mentioned, Gustav Magnusson, based out of Stockholm with EQT's headquarters and currently leading our climate strategy on a group level. Figured we'd just start giving a little bit more context following the previous speakers from the private equity side of things. A short intro to EQT and what we do. We're a global private equity firm with about 120 billion euros in assets under management. And I think the whole story around our science-based targets basically starts with our values and culture and history as an organization, and especially on the right-hand side here on this page, meaning then what we do and how we do things. And a core narrative with EQT for a very, very long time in order to create returns for our investors has been to future-proof the investments that we make and have a positive impact with everything we do. And in terms of how and where we invest, we have again a global footprint today. We invest in sectors such as healthcare, industrial technology, TMT. We have infrastructure investments, real estate investments. Not sure if the slides are fully following here. There we go. Pause there. And again, I think on the topic of science-based targets, I mean, decarbonization is the main challenge on a global scale. And again, it fits very well into how we aim to create long-term value for our investors in the first place. And I think in terms of our approach and how we think about net zero carbon at EQT, it's really based on three quite straightforward principles. Number one, understanding the starting point, as with any challenge you would undertake, and in this case, of course, the GHG emissions, both in terms of direct emissions for EQT AB as a corporate firm, but also indirect emissions, our investments, cascading all the way down through our funds, our portfolio companies, and their own scope 1 and 2 and 3 emissions as well. Second step, where science-based targets is, from our perspective, the flagship initiative to really drive decarbonization. This is where we spend most of our time with our investments to help them decarbonize the business first. Of course, renewable electricity transition, general energy efficiency measures, especially in real estate, very important. I think new products and services is also something that we will see more going forward in terms of how businesses aim to drive their own decarbonization pathways to also become more relevant in their own value chains going forward. Lastly, we are supporters of removals as well, offset credits. Very conscious in general that we pursue step number 2 before we embark on step number 3, but I think it does have a role to play, even though of course, we need to decarbonize first to the degree that we've committed to. I think looking at our targets as a firm, it's split into 4 main components, a little bit of a mix of methodologies. On the first 2 set of targets, we have an absolute contraction approach, and those 2 are regarding EQT as a corporate firm. On the listed entities, we have a 50% reduction target for our scope 1 and 2 emissions, 30% absolute reduction target on our emissions from business travel, which is the main source from category 1 to 14 in scope 3 emissions. Thirdly, we've committed to having 100% of our portfolio companies setting their own science-based targets by 2030, so 10 years faster than what was required from SBTi. Lastly, we have a 55% emission reduction per square meter, sort of the SDA approach in our real estate investments. And I think this has been a very, very useful framework to organize ourselves around and sort of being the flagship in terms of how we define our decarbonization targets as the EQT. Again, category 315 being the majority, I think it's 99.9% of our group level emissions at EQT. The third category here, i.e. the portfolio coverage approach for our portfolio companies, is the main source in our investment portfolio as well. It covers 98% of our invested capital, these targets. And we've been working quite diligently over the last 15 months since our targets were validated to really accelerate this program with our investments. Very happy to say that it's been better received than I thought it would have been. A lot of our companies have been asking us quite a lot for guidance. How should they think about decarbonization? How should they think about science-based targets? So this entire initiative is really proven to provide very strong guardrails and a very strong support model to our investments in these discussions. Also, I think to date, out of approximately 150 portfolio companies, maybe approximately 100 additional venture capital investments, we have now over 40 portfolio companies that have started their own science-based targets program themselves, sort of showing the potential for the ripple effects that we want to achieve here in terms of cascading science-based targets and emission reductions in the real economy on a global scale. I think a few interesting sort of learnings from our side, given the fact that since we are shareholders in these businesses, typically majority owners of the businesses, we're very close to them. We have a very active ownership approach, frequent contact points with board of directors, management teams, and the organizations below. I think there's been a couple of sort of strong levers that we pulled. We've spent a lot of time on training and capability building, both for our own investment teams. So every EQT employee, and especially the investment professionals, understand the commercial context for why we're doing this. Again, more trainings also with the board of directors for the companies. We typically appoint a board sustainability champion with each investment, where we would sort of have that champion on a more strategic level in the organization. Same thing with the CEOs and the chief sustainability officers or equivalent, to be sort of collaboratively driving this agenda forward together. Another strong mechanism, I would say, that we've deployed to accelerate this progress has also been with various types of ESG-linked financings, both on an EQT AB level, tying sort of KPIs to our portfolio coverage percentage, but also on a fund level financing facilities to not necessarily do it only for sort of the potential interest rate discounts in the facility itself, but more to establish this priority as more of a natural part of how we drive value creation with the companies overall. We'll round off from the EQT side with a few sort of general success factors and also a few challenges that we've encountered on this progress so far. I think number one, in terms of what's been going well, we've had very strong executive support in the organization. Again, decarbonization ties very well into the culture and the longer term mindset we have as owners of the businesses. We've had looking back 12 months, probably, we've had more of a trial and error mindset in terms of launching this, starting with a few of our portfolio investments where maturity is a little bit higher, build some proof of concept, and then continuously adjust the engagement model with the companies, seeing how we can improve, filling in any blanks, etc. I think it's extremely important to tie any decarbonization story. You need to tie it to commercial outcomes with these companies, integrating, sort of not having a sustainability agenda that's separated from the overall strategic ambition of the company, but rather finding the interlinkages and understand how we can sort of co-create a more green future together with strong business outcomes as well. And again, of course, not going to sugarcoat too much. I mean, there are, of course, challenges with launching this as well. I think there's varying maturity and also materiality for decarbonization across various sectors. If you think about sort of transportation and logistics or energy or similar sectors, of course, it's more top of mind. If you're speaking with a software company somewhere with only a few offices and 1,000 employees living in urban areas, it's more challenging to have these sort of strategic discussions. But then I think it's more about finding the appropriate upsides for them that could be relevant. General high growth businesses and energy volatility, of course, making sort of, at least in the short term, making it more challenging to drive this agenda, even though we're making sure to stay close. And then lastly, in the broader net zero puzzle as well, finding our role in addressing the larger polluters, sort of transforming them versus investing in lower intensity type sectors. Again, if you think logistics versus technology or software as the example for that. So I think there we're still to see exactly how we do that. But again, our SBTs has really helped us form one framework. We can communicate it in a fairly straightforward way to all stakeholders, both internally and externally, and has definitely been a strong execution so far. And I would encourage more to follow suit. I'll probably pause there.
Thank you, Gustav. That was fantastic, and thank you to all four of you for those fantastic presentations, and thanks for sharing how and why financial institutions are setting science-based targets. I think it's a really valuable experience and lesson to share with the rest of our audience. So thank you so much. I would like to round off the discussion by asking you all to answer one more question, and then we may actually have a little bit of time to answer one of the questions from the audience. But to kick it off, and I guess I'll start with you, Gustav, because your camera's already on, and then we can go back down through the presentations. But what actions are you taking to achieve your science-based target?
Probably touched on it a little bit, but again, I think the overall carbon literacy in any organization in financial institutions right now is probably relatively fairly low. So again, given we're in this for the long term, we need to really take the time to educate both sort of the staff with our firm, but also the relevant stakeholders in each respective investments. And I think one prime example of that is, I think 12 months ago, we would have companies not being too sort of cautious with committing to a scope 3 reduction target. But over the course of 12 months, sort of having brought these people onto this capability sort of learning journey, it's quite clear now that we're getting much more pushback on the scope 3 targets that they will set for themselves, because they start to understand what it actually means. They see the complexities in these things. So I think this is a strong example of sort of it started off easier almost, but it's of course the right way to go about things. Other than that, I mentioned it as well, but sort of ESG linked facilities has definitely been helping. I think finding the one sort of KPI on a group level that really moves the needle for us, it's been, okay, how many of our portfolio companies are where in the funnel of setting their own science-based targets? Extremely simple KPI to communicate. We have X amount that has committed, we have X amount that has validated targets. And I think that simplicity in the model really helps sort of anchor this internally and also supporting follow-up.
Thanks, Gustav. Yeah, those are really, really great points. Very interesting to hear what you have to say around kind of the more you learn, the less you realize you know about scope 3 and some of these other things. So yeah, definitely agree with that. I guess we'll go in reverse order for our presenters. So I'll call back Marcus to share some of the actions that you're taking to achieve science-based targets.
Thanks, Paulina. So I mentioned some of this in the presentation, but for the corporate bonds and equities, kind of the main two levers that we do is on kind of active ownership and dialogue with companies, and also through optimization and strategy setting, mandate setting as an asset owner, also in the funds as an asset manager. But what we've also done in addition is kind of lifted the kind of discussion up one level and had discussions with the Norwegian Ministry of Trade, since they own there's a lot of state-owned Norwegian companies, and also pushing for SBTIs, but also pushing for kind of including nature in the targets and work. So those are a few things. And then on the real estate side, it's all about kind of how to make our buildings more energy efficient to reduce the energy consumption needed, and also where that's relevant, how can we actually produce our own solar power on those buildings that we have.
That's great. And then Jenny, same question to you, and also to presenters, feel free to leave your camera on for the Q&A if you feel you would like to.
Great, thanks. Yeah, I mean, similarly, I sort of alluded to this in my presentation, but I can go into a bit more detail. So on our engagement program, which is obviously one of the main ways that we'll be achieving our science-based target, we're putting more emphasis on looking at sectoral based engagements. So bringing together the investment desks, the analysts who are looking at particular sectors so that they can discuss the challenges within that sector, particularly the harder to abate sectors. The only way we can get the numbers that we're getting for the engagements that I mentioned, so it was 700 last year, is by having all the investors running these engagements themselves, not just through kind of a central ESG team. So their involvement to develop our thinking and to share that amongst themselves is really, really important. And then similar to what Gustav said, I think the education piece is really important. So again, in order for us to have achieved the numbers that we did last year, and we're continuing to do this year, it was really, really important that we had an education piece that went alongside after having set our science-based target. So we had a climate engagement toolkit that was developed and shared with all our investors that gave them guidance on how to engage, what we expect, what the climate expectations are, and then how to track those so that it's all feeding into the system so that we can track it against our target. And then similarly, we're developing more climate tools so that we can do analytics that doesn't just look at current emissions and then targets way off in the distance. It's also about how are companies managing climate in between, how are companies what are companies facing in terms of physical transition and technology risks, and then technology opportunities as well. So we want to have this holistic view of every company that we're invested in, and it's really about empowering the investors to have that information and then to be leading the engagements themselves.
That's super interesting to see how those objectives are filtered to all of your investors to kind of drive that engagement forward. Thank you for sharing. And then finally, we have Supriya. If you could also share a little bit more.
Yeah, so I guess as I mentioned that we have launched a lot of products and opportunities for customers to learn and awareness. One of the other things is we have a 100 billion target for lending between 2020 and 2021 and 2025 to make sure our customers have kind of funding and financing available to support green activities, etc. So that's available, and that includes some products that we have set up. And I mentioned the green mortgages. So given we have a diversity of sectors, the actions in different sectors are different. But yeah, in the main, it's that sort of supporting their transition and having the products to support and invest in green opportunities.
Yeah, definitely. And I guess we just have a few more minutes, so I think we have time for one more question. We can go through it, a little bit more, maybe just a minute per person for an answer, and we'll go back in reverse order. So Supriya first, but if you could share maybe your top challenge, or if you can fit in 2 challenges around setting your science-based target, around methods and data, or you may have already touched on some of these things, so if you want to elaborate more, feel free.
Yeah, that's fine. I guess, as I said, so we have to gather our customers' carbon emissions data to be able to calculate our own emissions data, and that is our kind of foremost challenge, to have granular enough data for our customers to set our emissions. The other one is the methodologies, because we have such a wide range of sectors. The methodologies for different sectors are different, and that has taken some time to overcome. And as we are reaching this position of having targets and having measurement, I think the next challenge is then to actually cause change and supporting our customers' transition. So there's different difficulties at different stages.
Yeah, definitely. And Jenny, I'll hand it over to you for your main challenge, maybe how you overcame it.
Sure. Yeah. So, I mean, I think initially in setting up the way that, because we use temperature alignment, it requires quite a bit of kind of calculation of taking targets, then translating them into something that you can see as a kind of linear annual reduction implied over time. So turning target data, so we use MCI data, CDP input data, taking the data formats that they provide all that information in, getting that put through a code that can then translate those targets into a number. All of that, it's quite complicated. It's quite complicated to explain. It's sometimes quite complicated to track back. So, we get this temperature score output. Where did that come from? What was the target that underpins it? So all of this we're trying to improve over time, but that was probably kind of one of the biggest challenges. And then I would say with the additional asset classes, they have different methodologies. So again, we need to be able to translate targets for different types of asset classes into temperature scores. And again, we follow the SBTi methodology, but it's about making sure that it has as much integrity as possible. So we're obviously improving these as much as we can over time. And then, as our investors use the data, we can sometimes spot issues. So it's an interesting way of looking at implied temperature rise using the SBTi methodology. But it's, we're looking to improve it all the time.
Marcus, how about you from Storebrand?
Yes, thank you. I think kind of one of the kind of the issues, or specifically on the portfolio coverage method for equities and corporate bonds, is the sectors that as of today don't have kind of a framework to set science-based targets and get them validated. That's also some of the pushback coming from these sectors. So that's also a kind of a explicitly stated importance of SBTi to continue to develop pathways and the methods for all the sectors, especially all the high emitting sectors, and also kind of having the capacity to work with them and validate those targets.
And finally, Gustav, do you have any challenges to share?
Yeah, absolutely. No, I think, in a private equity context, I think the finite holding period is definitely something that is causing a lot of challenges, meaning that we on average would hold a portfolio company, let's say 4 to 6 years. That's only so much time to transform a company. Also meaning that longer term commitments become very challenging because we don't know what will be in the portfolio in 2030 even. Some indications, of course, and even less so in 2040. So I think that's a main challenge to overcome. The sort of how can we play our part in transitioning the businesses, whilst we know that even if one of our investments today set their own science-based targets, we won't be the private equity firm or other owner owning that business by the time they need to achieve them. That's clearly one, which also brings complexity mentioned before as well. But on data, I think scope 3 critical challenge to get better data for actual data based on consumption, for example, and stepping away from spend-based assessments and estimates. Definitely a key challenge on our side. And again, I think the general puzzle, how do you couple growth with reducing absolute emissions? It is a clear challenge. I think it can be done to an extent, but what happens with the sort of remaining 50%, call it that, and how you get that down to zero? I think that's definitely one other challenge as well. And we're trying to, I think in terms of overcoming this, it's more about taking one step at a time. We know what we need to act on within the coming 2, 3, 5 years potentially. So it's better to start there, act today, because we know it's only heading one direction, and then we'll continuously evolve and develop our priorities and approaches for this.
Great. Thank you, Gustav. Indeed, these are significant challenges, and it's great to see how each of your financial institutions has overcome these with your SBT. So thank you again so much for presenting today and for your leadership in the sector here. And we look forward to working with you going forward. Just briefly, in terms of where we're going this year and opportunities for all of the audience to get involved. For those from financial institutions that haven't set science-based targets, we encourage you to follow these leading financial institutions here and to set a science-based target for your investment and lending portfolio. Second is, as I mentioned, we're developing a net zero standard for financial institutions this year, and we would encourage all of you to participate in that standard development process. There'll be extensive stakeholder engagement there. And finally, there will be broader SBTi consultations around our new method development and other resources that we're putting out there, as well as broader engagement programs for different sectors in the real economy. And so we're very keen to include all of you in those as we continue to develop this initiative and increase the climate action of the private sector. So thank you again for everyone for joining today, and have a great rest of your day.